So I would like to introduce this last session of today, which is held by Morningstar. And this is a very particular session because the speakers are not present today because they couldn't make it physically, so they will join online. So for this session, I would like to welcome Lindsay Stewart, Director of Investment Stewardship and Research at Morningstar.
Good afternoon, good evening, everybody. Great to see some of you. I can't see all of you, but good to have you here. I understand I'm the last session of the day and I'm probably between you and some drinks. So I'm going to have a very quick fly through of ESG and investment stewardship, how we're moving from best practice requirements to actual requirements specified by regulators. So I'm just going to crack on and share my screen. Bear with me 1 second. Okay, I hope everyone is seeing this. So yes, ESG and investment stewardship, shifting from best practice to required practice. Quick introduction to me, I'm Lindsay Stewart. I work in Morningstar's manager research team. So I spend most of my time looking at investment stewardship from the asset manager's perspective. And we'll dig into exactly what we look at as we go through this presentation. There's a quick link to some of our recent content on this matter, which you will see again later on in this presentation. So you don't feel you have to hurry and snap that, but just cracking on. What is investment stewardship? Also known as active ownership, it's investors using their influence over potential investees and issuers, policymakers and service providers in line with responsible investment goals according to the PRI. What's interesting about stewardship recently is that it has become very much a focal point in the overall responsible investment or sustainable investment area. Why is that? Well, there's a lot of talk right now, especially right now between asset owners and asset managers about alignment and accountability. And I was in Amsterdam last week with Morningstar, really just digging into some of those issues. And the question is, how do you demonstrate alignment between a sustainable objective and what you're actually doing? How do you demonstrate accountability for delivering on the objectives that you've set? A lot of people are beginning to feel that the answer is in the investment stewardship approach. How are you voting? How are you engaging with companies? How are you engaging with regulators? And so those are the issues that we look at when we're analyzing a manager's approach to sustainable investing from the active ownership perspective. We're looking at engagement with issuers. Most of that's tilted toward the equity side, but increasingly fixed income and alternative assets are becoming a bigger part of that conversation. But what we're finding is that the engagement activity reporting, there's a lot of inconsistency over time and between different managers in terms of what kinds of activity are being reported, what objectives are being set, what qualifies as an engagement. So there's a lot more harmonization to be happening there. There may be a role for regulators in delivering that kind of harmonization, but we feel that the industry is currently in a position where they're trying to work it out in collaboration with their clients, particularly their asset owner clients, in terms of delivering that level of consistency. Switching to the middle, the proxy voting side has become absolutely crucial in determining what a manager's sustainable investing approach is, especially in the United States, where we've had this massive increase in the volume of proposals by shareholders at company meetings on environmental and social topics across a much broader range of areas, which we're going to discuss later. But we feel that proxy voting is one of the few areas in investment stewardship where you can get very, very specific and quantitative signals if you know where to look on how an asset manager's engagement and stewardship and sustainable investing approach is evolving. Over on the right, there's also public policy engagement, which is becoming a much more important theme. Some of you may have heard the words macro stewardship or system level stewardship in terms of how a financial actor engages with system-wide issues, not just individual sector or company issues, thinking about how those risks start to aggregate up for massive trends like climate change, like societal disruption, like biodiversity loss, really acting at that system level. And we're finding that the interactions between those financial actors and governments, regulators, supranational organizations is becoming more and more important, particularly at a time when new standards are coming in for example, climate reporting, social disclosures, and so on. And then wrapped around all of that is the increased need for disclosure and transparency on all of those activities. So providing things like stewardship reporting, voting reports, vote rationales, all of these things that asset managers' clients are increasingly asking for to demonstrate that accountability and alignment that we mentioned earlier. So what does evolving best practice look like? Well, here's how Morningstar is thinking about it. We think that active ownership sits right in the middle of a sustainable investing framework. So you don't have to be super highly intentional, not necessarily in the impact category of the right, but you're doing a lot more than just applying exclusions in line with your clients' specifications. It really does sit across the piece. And so whether you're in intentional funds or not, as long as you have firm level sustainable objectives, a lot of managers do on climate, but increasingly on things like human rights, workers' rights. We'll dig into that very shortly. There is an expectation that there would be an active ownership approach that goes along with all of that. What do we consider best practice at Morningstar? Well, at Morningstar, we do an assessment called the ESG commitment level that assesses asset managers' approaches to sustainable investing in particular. And as part of that, we do specifically consider active ownership and stewardship, which constitutes 30% of that overall assessment. And we split those various topics into policy, practice, and transparency issues, really drawing on that framework that we mentioned earlier. So on the policy side, the proxy voting engagement policies are expected to provide detailed guidance on which sustainable objectives a manager is pursuing across which funds and how it intends to act upon them in theoretical situations. Then we look at the implementation afterwards. And increasingly, we're reliant on investor briefs that further explain asset managers' positions on key ESG themes. And we've seen a lot of development, things like nature and biodiversity or political influence, things like that. There are various points on practice that we look at. For example, we look at how ESG engagements, proxy voting strategies are planned centrally or decentralized. You expect to see voting on key shareholder resolutions that are aligned with policy. Increasingly, we're looking at managers that pre-declare key votes is an indicator of leading practice on that. Contributing to the collaborative engagements, Climate Action 100 Plus being a key example, Nature Action 100 is another, but there are various other subtopics springing up on things like water risk, on social issues, on decent work, all those sorts of issues. So that's certainly proliferating. But again, that transparency has become a very, very important point. Voting records, voting rationales have become incredibly important to end beneficiaries, end investors, and asset owners in this area, including in engagement reporting and case studies, certainly becoming more important there. The range of environmental and social themes being considered is certainly becoming a lot broader than it used to be. There has historically been a very, very narrow focus on climate in most cases. That's starting to broaden out. On the social side, diversity, equity, and inclusion, gender inclusion, racial and ethnic inclusion, certainly in the United States and the United Kingdom, has become a key topic. And most managers have at least some objectives that we're seeing in those areas. But broader topics that are starting to come in, we saw the release of the TNFD, Task Force for Nature-related Financial Disclosures, a couple of weeks ago, and the Global Biodiversity Framework released just under a year ago. And so that has really focused investors' minds on the nature and biodiversity side. With water risk, among the recent droughts that we've seen both in North America, in Europe, and in other places, also starting to focus investors' minds on those risks. Perhaps sitting across that is also the plastic pollution issue, whether that's oceans or fresh water, which is kind of feeding into both of those topics. But then on the social side, especially this year, we've seen a lot more focus on workers' rights and fair workplace issues from a variety of perspectives, whether that's things as formal as unionization and freedom of association, or more specific topics like avoiding harassment and discrimination or violence in the workplace, especially in the United States, or the human rights and supply chain issues are also starting to come to the fore with modern slavery regulations starting to become embedded in investors' minds throughout the world. And then perhaps sitting across those two themes is the theme of political influence, whether that's climate-related lobbying, which has been a key area of focus for many investors over the last 3 years or so, or more general influence we've seen in the wake of COVID, proposals in the pharmaceutical sector asking questions about the impact of lobbying, or just general access to government influence as a risk management issue within various companies is certainly rising up the agenda. So a much, much broader range of topics is being considered than previously. So how are regulators and asset owners responding? Well, what we're seeing in the regulation is that whereas stewardship has previously been governed by best practice codes, and here where I sit in London in the UK, we've had the stewardship code, one of the first such codes in the world, which has evolved over many years, but those are starting to pop up in various jurisdictions. We're seeing new ones in Switzerland, in Spain very recently, and in different places in the world, Japan, various Asian and Australasian stewardship codes also starting to come through. But it seems that we're starting to build on top of that best practice and collaborative approach with clients to moving to an area in which regulators are starting to specify that asset managers who have disclosed sustainable objectives, either at firm level or at fund level, will need to also demonstrate that there is an investment stewardship approach that goes with that. And the example I have on screen is from the FCA in the United Kingdom in their proposed sustainable disclosure regulation, which is expected to be finalized before the end of this year. There's a new label that you may know of the Sustainable Improvers product, in which asset managers would invest in companies that are not yet considered sustainable with the intention that they would benefit from the transition over time. But it does explicitly state that there is an investor stewardship expectation and consequent expectation of transparency and disclosure around that with those kinds of products. And again, detailed product level disclosures, the proposals there also would require firms to set out in a clear and accessible way what the firm level and product level stewardship strategy and resources are. But it's not just happening in the UK. We also see in the United States, the SEC has an ESG disclosures regulation that it proposed last year, and it follows on the heels of the names rule that has just been finalized, which overlaps and covers quite a lot of the same territory. But in a similar theme, the ESG's focused strategies label that it proposed under that regulation specifically requires disclosure and transparency on proxy voting and direct engagement as evidence of delivering against that ESG-focused strategy. The SEC would require firms to disclose information regarding how firms voted in proxy votes at company meetings and specific information regarding how ESG engagement meetings have been delivered against. But it isn't just the regulatory side. Increasingly, asset owners, and I've got two examples from the UK on the screen, are requiring compliance with stewardship codes and setting expectations for asset managers. Or they may be starting to look elsewhere if those requirements are not met. The one I have at the top of the screen is Scottish Widows, based here in the UK, who requires ongoing compliance with the UK stewardship code or a local equivalent being mandatory to continue to benefit from the receipt of that mandate. Nest, also a national UK asset owner, expects asset managers to hold companies to account on a range of ESG issues through their voting. And increasingly, they're looking for alignment against market-leading standards, even if those standards do not necessarily apply to them in their jurisdictions. So they're looking for a very high threshold here from a lot of asset managers. So the requirements are certainly going up, and we're kind of moving away from this best practice voluntary into a world of requirements and expectations against which asset managers are expected to deliver. I said I'd keep it brief, and so I'm going to keep my promise. And so that's all I have in terms of prepared comments, but I'd be interested to hear if you have any questions or comments or observations on any of that. Again, the QR code for our recent content is on the bottom right of the screen if you are interested in finding out more. But if you have any questions, please do ask them. I'll try and answer them as best I can.
Any questions, comments, someone? Well, it looks like there are no questions, no comments in the audience. So thank you very much for hosting this session. Thank you to Morningstar as well. And this is the closing session and the closing remarks of the today's the first day of the Sustainable Investment Week. So we would like to thank you all for coming, for joining us. We'd like to thank you, say a big thank you to our hosts for sponsorizing the sessions and providing us with very bright speakers. So thank you everyone for your contribution, and we would be very glad to see you again tomorrow We will start at 12:45 with our lunch again, and then the sessions will start. So we hope to see you, and thank you, everyone.